Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. The trade war is back, and Wall Street seen a big sell-off here. President Trump threatens what he calls a massive increase in tariffs on China's imports, signaling relations with the nation are deteriorating. We're going more in depth with the market reaction. Right now, there's just an hour to go until the closing bell, and stocks are lower here. Let's take a look at the major averages. The Dow down is here 636 points. The S&P 500, your broad gauge, down 2%. Tech-heavy NASDAQ is down 2.7%. Let's welcome in here data and markets editor Jared Blickery to break down the news. Jared, what are you seeing in the markets?
Well, there's a lot of red. We haven't had a day like this, almost 2% down in the S&P 500 since April. And if you'll remember, that was the post-Liberation Day lows. And let's just get a sense of the price action for the day. This is actually the whole week. Might as well start here. Had some green, had some red, but really fell off the cliff today on that Trump announcement. And I'm going to dial this down to a day chart, and we're going to go straight to the Dow Industrials. Down a little bit less, about 1.4%. Spent a little time in the green, but that was wiped out very quickly on the news. NASDAQ Composite taking it the worst. Tech is down by the most today as far as the sector action is concerned at the lows, and it is down 2.77%. And I want to show you what's going on in bonds because they are being bought. And as bond prices go up, the yields go down. That's what we're looking at here. The 10-year T-note yield down 10 basis points to 4.05%. The 30-year down 10 basis points as well to 4.63%. And let's take a look at the US dollar as well. That's down a hefty 0.6%. And this is different from what we saw in the post-Liberation Day sell-off because investors were dumping the dollar, but they were also dumping bonds, which means the yields were rising. And that was a much more dangerous situation. So that is not what we're facing today. So that's a little good news there. Want to show you what's happening in volatility land. Have not seen a VIX with a 20 handle in quite some time. Here's the 3-month chart going back. You can see almost about the level that we saw around August 1st. That was another big day. Nowhere near, though, the levels that we saw in the post-Liberation Day sell-off when we had intraday, I think north of 60. So nothing approaching that right now, although it's a little bit of concern for investors. We haven't seen anything like this for some time. Then here is the sector action. XLP, that is consumer staples, kind of defensive. That's the only thing in the green and just barely at that. As I said, tech taking it on the chin, down 3.09%. Energy, the second worst off, and then consumer discretionary down more than 2%. Those are the underperformers. And let's take a look at the NASDAQ 100. Lots of dark red here, especially in the chip stocks. And plus, you see Tesla down 4%, Broadcom down a bit more, Amazon down 4%, Apple down 3%. List goes on. And let's take a look at the Dow as well. Aside from Coca-Cola and McDonald's, some of those consumer defensive names, you really do see a lot more red than green here. In fact, almost all of that red. Nike down 4%, a lot of China exposure. And let's just jump to the China leaderboard here, where you can see Alibaba down 8%, Pinduoduo down 5%, Baidu down 8%, and the list goes on. So a lot of carnage within tech. Here's a quick look at the semiconductors, a lot of dark red, and all you got to do is judge by the color on software as well. Not as much dark red, but some of those names experiencing some pretty sharp losses here. Shopify down 7%, SAP down 3%. The list goes on, and Josh, I'll send it back to you on that.
All right, thank you, Jared. Appreciate it. Well, with fresh threats of tariffs, markets reacted swiftly, as we've been discussing. Our next guest, Jeff Schulze, is ClearBridge Investments Head of Economic and Market Strategy. Jeff, it is good to see you. So as Jared was just saying there, listen, U.S.-China trade tensions, Jeff, they're back in focus. You can see stocks sliding here. President Trump clearly sounding frustrated, Jeff. He's threatening these massive tariff hikes on China. Big threats. No specifics yet, Jeff, but big threats. I'm just curious, you saw the post. You see the market response and reaction, Jeff. What do you make of it as an investor?
Well, as Jared mentioned, we haven't had a 2% sell-off in close to 6 months. It's been almost a straight move higher off of the Liberation Day lows. And investors were looking for an excuse to sell, and this is as good of an excuse as any. This calls into question the President Trump and President Xi meeting in Korea at the end of the month. And if the truce is not extended by November 10th, tariffs could move back up to 145%. So that certainly is a real risk. I think that some of this volatility and uncertainty will bleed into next week, which could create more downward pressure in markets. But ultimately, we are buyers of this dip because when you look out to 2026, you have a very powerful policy mix of Fed rate cuts and the peak stimulus from the One Big Beautiful Bill, which is a policy mix that you only see out of recessions.
So you're buying on this dip, Jeff. What would make you question that decision? What would make you question that strategy?
Well, if we start to get closer to November 10th and it doesn't look like things are thawing between the U.S. and China, that means that there is a real risk for a dramatic escalation of trade tensions. And let's not forget, even though Chinese imports are down 30% on a year-over-year basis, it's still the fourth largest trading partner for the U.S. So that would cause a lot of disruptions and then bring back a lot of that anxiety that we saw in March and early April.
So I'm curious, Jeff, so you're buying this dip, you see it as an opportunity. When you saw that headline though, Jeff, and it looks like, all right, trade tensions ratcheting back up, tariff threats ratcheting back up, heat ratcheting back up between Trump and Xi, does it make you reconsider at all, Jeff, how and where you want to commit capital?
It doesn't. And given the policy mix, as I mentioned earlier, and the fact that earnings expectations are continuing to move higher, not only for 2025, but for 2026, I think you want to be exposed to the more cyclical areas of the market. We like consumer discretionary. A lot of that peak fiscal impulse next year is going to be going through higher tax refunds in the first half of 2026. That's going to support the consumer and consumer discretionary more broadly. We like financials. We're going to get a steeper yield curve as the Fed continues to cut, some looser financing conditions. So we think loan activity is going to pick up, more M&A activity, less regulation. And we also like IT. We think that IT CapEx story is alive and well and will continue into 2026. So what has been working may not be working today, but we think there will be a continuation of that next year.
What about, Jeff, I've had investors come on, maybe more on the skeptical side, who've said, listen, big move off that April low. Valuations are looking too stretched. I mean, you heard Jay Powell himself seem to suggest, he says, we're looking a bit stretched here. What do you say to those? And listen, they would, I think, acknowledge valuation is not a market timing tool, but what do you say to those who do believe we priced in a lot of good news at these levels?
We have, and I think that's why we may see some volatility right now. But ultimately, I think earnings delivery is going to surprise to the upside next year. If you look at GDP now, third quarter GDP is expected to be 3.8% compared to the last 3 months of job creation averaging 29,000. Wage growth continues to go down. What that means from a corporate perspective is higher revenues and a cost structure that's remaining in check, which will ultimately feed through to better bottom line delivery. And I think the markets have started to sniff this out. And I think that earnings expectations are going to continue to move higher next year as this comes to fruition. And it's not just a Mag 7 story, in my opinion. I do think next year you will see that earnings delivery broaden out to some of the laggards, that small caps, of mid caps, value in the S&P 493, which is, of course, without that Mag 7 included.
Speaking of Mag 7, Jeff, I want to talk to you about that just mega AI trade and trend, so critical to this market. You've heard investors, including some very well-known ones, Jeff, throw some caution flags, questioning whether the boom is a bust. How do you think through that?
Well, I think the costs of not investing are greater than the cost of investing at this point. It could be a winner-take-all type of environment. And the investor sentiment has really kind of looked through all of that free cash flow generation that's being thrown into that AI CapEx cycle. So until there are tangible signs that there is overinvestment and their payoff isn't going to happen, I don't think investors are going to punish the hyperscalers that are investing aggressively into this new technology.
Jeff, we almost got through the entire segment without talking about the government shutdown. I'm going to guess, Jeff, you're going to tell me as an investor, you're looking through that, but elaborate on that for me.
We are looking through it. The markets were looking through it until today's news on China. Unfortunately, we don't have the catalyst of a debt ceiling agreement to bring that government shutdown forward. But ultimately, it does shave about 15 basis points off of GDP for each week that the government is shut down. But when the government does reopen, you do get a little bit of that growth back. So I don't think that this alters my view of the economic trajectory next year. And it certainly doesn't alter my view on the earnings expectations either. So I think this is more smoke than fire.
Jeff, good to see you. Enjoy the weekend.
Thank you.
Well, coming up, chipmaker Qualcomm may be the latest pawn in rising tensions between China and the U.S. over tariffs and trade. We're taking a deep dive on that. The Bureau of Labor Statistics will get the September CPI data out. It's all because of Social Security. We're going to give you the latest details on that story. And if you're ordering DoorDash at the office or at home this weekend, you may be served by a robot. We're going to tell you more about this partnership of the future, those stories, and more when we return. Semiconductor and wireless telecommunications company Qualcomm may be the latest pawn in the U.S.-China trade fight. Our tech editor Dan Howley joining us now with more. Dan.
Yeah, Josh, the Chinese government's state market regulator is opening an investigation into Qualcomm, basically kind of as a tit for tat almost with regards to the ongoing trade tensions between the U.S. and China. Now, this came out originally, and then shortly thereafter, we had seen President Trump post on Truth Social about China discussing rare earth minerals with other countries, and then saying that he may have to ratchet up tariffs on some Chinese goods shipped to the U.S. And obviously that's led to a sell-off for the markets. But this is something that we've kind of seen China work with before as far as its markets regulator. They've gone after NVIDIA in the past. They had a primary investigation. Then in September, they said that they were launching a fuller investigation into NVIDIA. NVIDIA's denied any wrongdoing. And they've used the government in other ways against chip makers from the U.S. In 2024, they went after Intel, saying that there were persistent flaws in some of their chips. That was from some of their cybersecurity folks over there in the government. And so this is clearly kind of this ongoing saga between both governments as they try to work through some kind of trade deal. But obviously tech being a huge benefit for the U.S., that's kind of one of the big weak links between the two. And so could continue to be a kind of pawn in this back and forth argument.
We'll keep watching. Dan, thank you. Appreciate it. Well, while the government shutdown persists, the U.S. Bureau of Labor Statistics is calling back workers in order to compile September's Consumer Price Index report. The BLS is set to release the data on the morning of October 24th. Here with more on the significance of this move, we have William Beach, Fiscal Lab on Capitol Hill Executive Director and former Bureau of Labor Statistics Commissioner. Bill, good to see you again. So the government shutdown continues, but BLS being recalled, Bill, to finish the September CPI report. Maybe just start, Bill, I'm curious, can you walk us through the sort of consumer implications of this? You know, what does this mean for Social Security checks, for COLA announcements, for payments, Bill?
Yeah, well, it's good to see you again, Josh, and glad to be talking about BLS. And looks like we're going to get a CPI report for September. I'm really kind of surprised with everybody else. So here's what's going on. The COLA adjustment recommendation from BLS, because BLS makes that every year to the Social Security Administrator, is due on November 1st. It is composed of the average of the CPI for July, August, and September. Well, we've got July and August. It's in the bank, but we don't have September. So I guess the administration really wants to make sure we don't miss this COLA adjustment. Obvious political overtones there. So they've called back about 200 workers at BLS to do the following. That is to process the September results, which, by the way, were fully collected before the shutdown started, to write the report, to get the report up on the IT system and get it out to all the waiting Americans. They're going to do every one of the CPI series. For those who are in the know, this is the CPIW, the CPIU, the change CPI, the experimental CPI, the elderly CPI. It's the WCPI, the all workers and clerical workers CPI that is needed by Social Security. And one more thing, there's another customer for this, it's maybe even more important, and that is the FOMC, Federal Reserve Board's Open Market Committee. They're going to be meeting later this month, as all your viewers know. I'm sure you've told them many times. And they'll be really happy to get a fresh CPI report, which I guess they didn't really expect. So there are two big customers there, and I think we're all to the betterment by having that report out.
And it sounds like, Bill, based on that answer there, you would have full confidence in this CPI report? I only asked, Bill, because I just wondered whether you would have any questions about it, given, it's taken place during a government shutdown. And I guess my question to you was, does that in any way, Bill, does it increase risks of errors or mistakes being made?
Yeah, I don't think so. I mean, first off, it was fully collected before the shutdown. That's really important. And then the same staff that's been doing this for years is going to be doing the processing of the data. That's all going to be up and running and writing the report. And boy, I tell you what, they're going to be doubly checking this report because everybody is going to ask the same question you asked. Now, let me just shift for a moment. We're not collecting any data right now, any price data for October. And here we are, October, what's the date? 10th? And I think that maybe there's a good chance we will miss the October CPI because you can't go too many more days before you just don't have enough days of collecting data on the hundreds and hundreds of products for the CPI. So I think that's the one that's really at risk. But I have full confidence that this CPI report will be gold standard.
So let me ask you, Bill, if you did miss the October CPI, and maybe even November, what are the ripple effects of that for both consumers and investors that are listening right now?
Well, I think we just lose track of where prices are going. I mean, there are a lot of private sector price series. We have the Million Prices Project. We have all of these, but everybody calibrates to the CPI because that's the standard. That's kind of like your spinal column. You could lose a rib or two, but if you got your spinal column, you're okay. Pretty awful analogy, come to think of it. But so I think it is problematic, particularly if you're a company going to do a merger and acquisition and you want to price out your hurdle rates, you want to forecast out what your CPI is going to be, what those prices are going to be for products or for wages or for any of the elements that go into those calculations. A lot of important decisions need to be made by the Federal Reserve and other banks around the world who use the American or U.S. CPI for calculation purposes. And then Josh, we're not going to get the jobs report for September. That's not being reconstructed, republished, or published. However, based on past practice, what I think will happen is OMB will issue a new calendar as soon as the government opens, and you'll see the September report either come out right away or it comes out on first Friday in November. That's been the practice in the past. So we're not going to miss any reports, though we could miss collection of the October data on both prices and on employment if the shutdown continues for very much longer.
Last question, but you mentioned the OMB there. I did want to just get your take on this. It does look like our OMB director did announce the government has started firing federal workers as the shutdown continues. It doesn't look like, Bill, we have a firm, clear line of sight of how many workers, but an OMB spokesperson did tell CNN layoffs are substantial. Curious to just get your take on that.
Well, BLS is down by 22% right now. We've got 11 of 37 senior positions. These are the management positions. They're empty. You can't do too much more in carving out personnel at BLS before you get real degradation in the ability to produce. It's maybe not the gold standard quality, but just the production cycle. But this is true of all the statistical system. You look at BEA, they're even though it does the GDP reports, they're down by, I think, almost 30%. The Census Bureau is down by 20%. So the statistical system has been hit pretty hard by the early retirement program. And I'm hoping that they leave the statistical system alone. We need it. It's like roads and bridges. It's infrastructure for our economy. So let's cut somewhere else if you have to cut.
Bill, always great to see you. Enjoy the weekend.
Thank you, man.
Coming up, we're talking trending tickers, plus new AI-powered robots are joining DoorDash's fleet. We're going to tell you everything you need to know about this partnership, that story, and more coming right up. Now time for some of today's trending tickers. Going to start off with the Chinese stocks. Companies like Alibaba, Tencent, Baidu, all sliding in today's trade. The move lower comes as President Trump threatens to impose massive tariffs on Chinese goods. Trump also canceling his meeting with Xi Jinping that was meant to take place at the APEC summit in South Korea in 2 weeks. Trump writing in a social post that China is becoming very hostile. Elf Beauty stock also taking a hit here amid the trade tensions between the U.S. and China. The company does source 75% of its products from China, making it highly exposed to higher costs from Trump's tariffs. However, Elf has been looking at business diversification when thinking about tariff mitigation. And turning to AstraZeneca, that company is expected to announce a deal with President Trump. According to reports, the deal is aimed at slashing drug prices. This would come as Pfizer, remember, has already made a deal with the Trump administration to cut some drug prices by as much as 85%. And turning here to Levi Strauss, that stock sliding following the company's quarterly results. While the retailer beat on earnings for the third quarter, guidance fell short of expectations. Levi lifting its full-year earnings guidance was not enough to meet Wall Street's estimates. Morgan Stanley noting that the company failed to convert improved revenue trends into significant profitability expansion. Well, the future is here. Serve Robotics, the autonomous delivery startup that's backed by Uber and is now working with DoorDash, marks a major milestone. The company expanding operations with more delivery robots than ever before and in more cities. Ali Kashani, Serve Robotics co-founder and CEO, joining us now. Ali, it's good to see you. Walk us through this partnership with DoorDash. Ali, what does it mean for the company? I'm curious, how many orders could it potentially add for you all?
I mean, look, this is super exciting for us. DoorDash is one of the largest platforms in the world for food deliveries, and they're one of the largest in the US as well. We want to reach as many customers and merchants as possible. We already serve 2,500 restaurants in 5 cities. And as of earlier this week, we put our 1,000th robot out in the market. So we want to have access to as much demand as possible.
Now, DoorDash, here's what's interesting, Ali. I was reading DoorDash has its own robot too. I think it's called Dot. So what is your sort of competitive advantage here, Ali? And is there any risk that this partner at some point becomes a rival?
You know, there are a lot of room for robots out there, and these robots are very different in their nature. So theirs operates on the street and can, navigate faster, further distances. Ours is primarily focused on sidewalks and is for denser environments. I think they are, the right vehicle for each delivery, and I don't see these necessarily competitive. I also think there are billions of orders being fulfilled every year, and for the foreseeable future, there is demand for more robots. So the more, the merrier.
Let me ask you, can you remind me just the kind of unit economics at work here, the cost of delivery with one of your robots versus a person delivering food products?
Yeah, I'll give you a couple of numbers. So if you order something from China right now, it would cost about $2 to get it to you. If you order it from Chinatown, some of the estimated numbers out there is about $10 fully loaded cost to get that item from Chinatown rather than China. So that's a big difference. We are trying to bring that $10 down to $1. It should be cheaper to get something from your local economy than it is to get it from China.
I did see, Ali, listen, the stock is down today. I did see a headline. You announced here, Ali, a $100 million registered direct offering of stock. Just tell us about that, Ali. Why now, and how are you going to use the proceeds exactly?
And look, we are growing really fast. We went from 100 robots at the beginning of the year to 1,000 today. By the end of this year, we're going to have 2,000 robots. Of course, we want to continue growing. It seems like a good moment. I think the stock has done well. And we've had a couple of exciting weeks. We launched Chicago last week, announced 1,000 robots, announced DoorDash partnership. We want to build on that momentum.
Can I ask you, Chicago's interesting. How do those robots, Ali, how exactly do they perform in a Chicago winter?
Well, we just started. I'll report back. Let's talk again after the winter. But the robots have been designed to handle weather. We have been testing them for now years. Now we are expanding our footprint. We're becoming basically a national, operation. We are now in 5 cities: Miami, Dallas, Atlanta, of course, LA, which was our origin, and then now Chicago.
As you expand, Ali, into cities, how do you choose which cities to expand into? What are the variables that go into that decision?
There is a number of things. One of them is obviously demand and concentration of restaurants and population. A lot of cities have really good neighborhoods for robots to operate, so there's a lot of options to choose from. We want to go to cities that embrace the technology and innovation. We don't want to go to a place if they have reservations about this sort of thing. So generally, the places we've been are really welcoming. Now, I should say by default, robots are not banned. They're actually allowed to operate anywhere. There are no laws against them. But again, we want to be friendly. We want to be collaborative with the cities. And then, of course, we talk to our partners. We want to know where they'd like us to go. And that usually is, again, where there's a lot of demand and there's not enough labor.
Where are your robots built, Ali?
They're built in Michigan.
All Michigan. So you were exposed to no tariff threat here?
Well, we have parts and sub-assemblies that come from out of country, but the exposure has been, fairly managed.
I'm just curious, Ali, how you sort of mitigate that risk?
Well, we really did kind of see this coming for a while and made sure we're not manufacturing in China, for example. Diversify, have multiple options. There's still some impact, but one thing we did, we actually went above our targets in terms of costing down the robots to the point that when the tariffs were introduced, it really didn't impact us. It kind of offset some of the additional cost savings.
Ali, always good to see you. Thanks for your time today.
Good to see you. Thank you.
Well, Kia is firing on all cylinders. The Korean automaker is notching record sales driven by flagship models and new electric vehicles. For more, we're bringing in now Yahoo Finance senior auto reporter Praz Sumrain. Praz.
Yeah, Josh, sales up 11% in September, right? Good month, a record-setting month, 9% in third quarter. Company doing well here. We're in a post-tariff world and things like that, and EV tax credits going away. But the Kia story has been one that's been going on for quite a while now. We were looking into that. One of my editors here tipped me off because he said, "Hey, I saw a nice Kia on the road. What's going on there? I thought they were kind of this brand that people made fun of." It's like, well, yeah, things have changed. Back in the day, began selling in the U.S. in the mid 90s, and people thought, hey, they were kind of like econo-box cars. Kia then did this thing where they offered a 10-year, 100,000-mile warranty, powertrain warranty, to get people on board and say, hey, we'll stand by our products, and that sort of got the ball going. And for funky kind of cars, and then you saw the quirky ads like the Kia hamster promoting the Kia Soul, and you saw the wrapping hamsters, things like that. Like just kind of like funny ways to get people kind of top of mind with the cars. But then what happened? I think there's two big things, and I talked to a Kia executive about this. One of those is the Kia Stinger. It was a really just amazing, like BMW rivaling sedan, a very powerful, big sedan, rear-wheel drive. Drove well. So I said, hey, Kia can actually do things in the automotive space that are pretty impressive. And then the one thing that Eric Watson, who is head of sales there in Kia, was talking about is the Telluride, right? When the Telluride came out, it made a big deal. And he told me, quote, he said, the Telluride was a huge piece of redefining who we were as a brand and attracting a different type of consumer. Meaning you're starting to see people middle class, upper middle class driving Tellurides around, which you wouldn't necessarily see people as Kia customers, right? So they're bringing new customers into the fold. Now, there were some hiccups, right, with this Kia story, right? There was the ICE raid earlier this year, where that the Kia and Hyundai plant in Georgia was raided, and it was workers who were legitimately there were kicked out and things like that, and it sort of delayed expansion of that plant, right? Because that's a big deal. They're making cars in the U.S. Also, the Kia Challenge. I think a couple of years ago on TikTok, where it was sort of discovered that there was a security anomaly or a defect where you could steal these cars pretty easily, and people were filming that and putting it on TikTok. A lot of people got their cars stolen. Big settlement there. They fixed it. They're trying to rebuild the trust again, but that was not a good look for them. But hey, looking forward, they want to keep growing the U.S. They want to get that market expanding here. The new Telluride's going to come out in hopefully, I'm not sure, in a few months maybe, or maybe next year. And then also they want to add an EV pickup to the actual lineup here, and they want to sell 90,000 of those a year, so we'll see.
I wanted to ask about EVs. So Kia is still betting on EVs, correct?
Yeah, they've been doing quite well with EVs, right? So they have a EV9, which is a full-size 3-row pickup. There's not that many EVs that are 3-row SUVs. That's kind of beauty, and it's price competitive, like $50,000. That's not bad, right? Also, the EV6 is more of a crossover, station wagon, hatchback type vehicle, a bit sportier in a GT form. That can go 0 to 60 in like 3 seconds. Very impressive EVs. They're able to keep the cost down because they're like basically fully vertically integrated. Right? They make the batteries, they make the steel, they make everything. So they can bring those costs down, pass on to consumer, in some cases build in the U.S., and that sort of gives them that sort of that recipe for success here, even without potentially EV tax credits.
All right, Praz, thank you, buddy. Appreciate it. Coming up, Wall Street's bull market marks a milestone. We're digging into the last 3 years and where stocks may be headed next. The bull market is celebrating its third anniversary, and Yahoo Finance's Jared Blickery breaks down what's ahead for markets.
3 years ago, the 2022 bear market bottomed. And as year 4 of this bull market kicks off, investors want to know how much room we have to run. And that's what we're focusing on in today's Stocks in Translation. This first chart here is courtesy of Keith Lerner over at Truist, and is showing every third year of a bull market since 1957. Notice the far right. The current year, year 3, is the strongest of the bunch. So now we've got momentum, but how long do these bull markets typically last? Well, zooming out almost a century, here are the S&P 500 returns for all the 15 bull markets since 1932, including the current one. The bar at the far right is the average of the prior 14, which is almost double the current return of over 85% in the S&P 500. On average, bulls last about 5 years, 2 years longer than the current one. So at least according to history, this is not an old bull market just yet, and there's more theoretical room to run. Now let's see who did the heavy lifting. And for that, we're going to first turn to the S&P 500 sectors. This is going back 3 years, and you can see XLK here is up 139.5%. That is the leader. And if we take a look over the last 3 years, you can see a few hiccups and some sideways action here. And by the way, that's when NVIDIA was also going sideways, but it has really rocketed recently. Number 2, that's communication services. That has Alphabet, and it also has Meta. Then we have industrials, financials, each up more than 70. And then XLY is consumer discretionary, bunch of retail names with Amazon and Tesla at the lead. Now, if we drill this down to 1 year, you can see a little bit of red. But aside from materials, XLB there, all the red ones are defensive, so this is still bullish in nature. Number 1, that's communication services with 26.8%, and then tech, and then consumer discretionary. Those are the mega cap sectors, so there are concerns of concentration right now. Even number 4, XLU, that's utilities, up 15.6%. Well, that's kind of an AI derivative play right now. So let's check out the NASDAQ 100. And here we can see in the upper left there's good old NVIDIA, $4 trillion stock, up 40% over the last year. But I'm going to change that to a 3-year look where it rockets higher to 1,523% and change as we're talking here. Here's a quick chart, and you can see there's that sideways action that we were seeing in tech that also corresponded with NVIDIA taking a pause, but again, rocketing higher very recently. But guess what? Palantir up 2,150%, that tops it. And you can see this has just really rocketed up mostly over the last year. We had a lot of green on this chart and not a lot of red. So let me just skip over to some of our leaders, where in the upper left, when you take a look at some of these sentiment ETFs, GBTC, that's my Bitcoin proxy, up over 800% over these last 3 years. In second place, we got the chip stocks at 166%, then MEG 7 ETF, then ARK Innovation Fund, then we got software, the Qs, that's basically the NASDAQ 100, an internet ETF, and ITA. ITA is interesting because this was a really good defensive play when we had the post-Liberation Day sell-off. It didn't fall off as much as everyone else, and it's probably still a pretty good diversifier. So putting it all together, we got some good options here. We've had a lot of bullishness, but let's take a look at what to look for in the coming weeks and months as we head into the 4th year of this bull market. So as earnings from big tech come rolling in over the coming weeks, you want to pay attention to the AI leaders, which are currently priced for perfection, as the street says. Any misses, especially on future guidance, that could bite. Then we want to watch out for sector rotation on any pullbacks in tech. Rotation is the lifeblood of bull markets, as they say, and we want to see investors move into other areas besides tech to keep this bull market alive. Then you got to watch gold flows. According to the work of Todd Sohn at Strategas ETF Research, the 1-year flows in gold ETFs have just reached the same level in 2020 that occurred just as the price of gold was topping and starting to turn down. Now, history doesn't have to repeat, but gold ETF flows are red hot. And if the trend reverses, that could hit the price of the yellow metal as well. And now that Bitcoin is back to record highs, watch the crypto bid. Bitcoin is famous for reversing short term after hitting new highs, and a dip below 120,000 would be an orange flag for risk sentiment in general. Finally, meme stocks are surging, albeit for different reasons in 2021, but it's incredibly interesting that Roundhill just relaunched their meme ETF a few days ago, and when they first launched their meme ETF in late 2021, that essentially top-ticked the initial pandemic bull market, and it was the start of the 2022 bear. So putting it all together, this is not an old bull market by historical standards, but it is very speculative lately. Earnings will set the tone soon, so stay alert. And tune in to the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Kicking off another earnings season, and our next guest sees names like Goldman Sachs and Citi separating themselves from the pack. We're navigating how to play the banking sector with the Yahoo Finance playbook, and joining me now is Ken Leon, Director of Equity Research at CFRA. Ken, always good to see you. So let's talk about the banks. Let's look at the XLF. We're down, of course, today, Ken, but that's a nice move off that April low. Heading into this earnings season, Ken, how would you broadly characterize valuations for this sector, for your coverage universe, Ken?
Well, it's great to be here. And that was the big question we had really in August is, can these banks, the global U.S. banks, can they really earn their valuation? We also got some feedback at investor conferences in September from many of the large banks, and the managements are fairly optimistic in terms of market conditions and outlook. So as we look to next week, Tuesday, with the banks beginning to report, JP Morgan, Goldman Sachs, and Citigroup, we think expectations are high from investors, but we still see the opportunity for both a revenue and an earnings beat from many of these banks. And we've been tracking that closely over the last 6+ quarters, and they've been delivering on the results.
I want to dig into some of those names with you, Ken, but another question I have for you, I'm just curious, what does the regulatory landscape look like right now, Ken? You know, what has changed under this Trump administration, and what do you see changing ahead?
Yeah, that's a great question. And you know, for any CEO under the limelight, you know, it's a delicate dance with the Trump administration. But what we have seen so far is policies that are at least fostering U.S. economic growth. We're also seeing a regulatory framework from the Federal Reserve that is likely to be more pragmatic and enable these banks to do two things. One, have more confidence to increase lending into the economy, and two, the ability with outsized capital reserves to return them to shareholders. So I think it's a pretty good picture, but again, what you're going to hear from the industry and these banks is really keep a low profile here.
How do trends in credit quality look, Ken? I'm just curious, given what we hear about the consumer.
Yeah, bank analysts are a very nervous lot, and if you go back as far as I have, which is well before even the financial crisis, you're always worried about any kind of black swan event in the capital markets, or of course something disastrous that's going to affect credit risk. CFRA, we look at all the banks every quarter. We look at a lot of different metrics, and overall we're still in the safe, normalized range in terms of loan loss provisions, loan reserves, allowance for loan losses, et cetera. So generally, and we're not even seeing anything episodic with an industry that could be distressed. So we're always watching, but I think this will be more to the back of the bus when we hear what managements have to say about their results.
You know what I always like about CFRA, Ken? You guys don't just do buys. You do strong buys on occasion when warranted. Goldman Sachs, you say, that's a strong buy. Why, Ken?
You know, it's very interesting. And again, my check on the banks like Goldman in August, and then where we are today. Today, there's 30 plus analysts covering Goldman Sachs. It has the lowest ratio of buy recommendations versus JP Morgan, Morgan Stanley, Citi, et cetera. And perhaps that's because of price performance, but our investment view really since May and still today is the delta to drive higher fundamentals, higher results is the capital markets and investment banking. And Goldman on equity underwriting on a global basis was number one. We're also seeing durable recurring fee income for Goldman coming out of asset and wealth management. And we're well past that experiment of getting into retail consumer finance.
What about Citi, Ken? Correct me if I'm wrong, but I feel like last time we spoke, you were a fan of Citi, of Jane Fraser and her strategy.
Yeah, I still am, but it's not like we're vulture bargain hunters right now. It's no longer trading at 30% discount to net tangible book value. So trading just above par. The other banks are valued higher. I think from Citi, you're going to see confirmation of what they've done with the restructuring. Just a week ago, they announced a buyer for Banamex, which was their consumer bank in Mexico. So Citi's aligned up, much more transparent to their businesses, predictable corporate treasury services, trying to get more wallet share and wealth as well as investment banking. She's done a good job. The stock is still, the most attractive on valuation.
We've been talking about some buys, Ken. There is a hold here I see in your coverage universe, Bank of America. So you're lukewarm there. How come?
The stock has actually done well in the last few weeks from, let's say, 42 to 50. When we think about Bank of America, not only over the last 6 quarters, but the last 5 years, it's been a laggard on performance, even to peers such as JP Morgan Chase or even Citi. And, there's nothing wrong with Bank of America. Certainly it stacks up well to the regional banks. But overall, we just don't see that outsized performance. And again, when we look at Bank of America, there's a lot that has to work well here. It's not only just loan activity, but when rates come down, it could put some pressure on spreads and net interest income. That's about 60% of total revenue. So nothing wrong with it.
Ken, 2 more names I want to squeeze in here because I want your thoughts. Morgan Stanley and JP Morgan, what are you telling clients?
So Morgan Stanley, almost just like Goldman Sachs, but much more leaning into wealth management besides investment banking. They're going to be at the top of the stack with Goldman in terms of, I think, earnings and revenues beats. They're also looking to gain wallet share outside the U.S. JP Morgan Chase, back in the summer, we got off from a buy to a hold. We came back with a buy. And again, when you look across all the businesses and the executive talent that JP Morgan Chase has, we think it's a winner, and it's one of the top 3 constituent in the financial sector. So it better work well because we have an overweighting on the sector.
Ken, always appreciate your time and those stock picks. Thank you.
Thank you.
We're wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.